starting. All attendees are in listen-only mode.
Hello and welcome to today's webinar. We're fortunate to have Claude Spurlock, Director of Mortgage Production for SC Housing, here to talk about the SC Mortgage Tax Credit Program. We also have Clayton Ingram, who is with their Marketing and Communications Department. Claude joined the authority in February of 2003 as a consultant and became a permanent employee in February 2005. He has over 30 years of mortgage banking experience. His career includes a full range of mortgage lending experience in originations, production, operations, and loan servicing. He holds a BS degree in accounting from the University of South Carolina. Thanks for joining us, and now I'm going to turn it over to you.
Welcome. Glad you all were able to attend this webinar today. And we're going to talk about our relaunch of the South Carolina State Housing Tax Credit Program. Some people have used it in the past, and it's a great program that we will be talking about today. And we will see if we can get the slides to work here in just a second.
There we go. Now we're cooking.
Okay.
So it'll be a mouse click.
Okay.
Technical problem.
Sorry about that. Of course, here's the South Carolina Tax Credit Program, or called an MCC, through the IRS. There. Of course, we have to have a disclaimer in case we say something wrong today. But here's their disclaimer that we have. You can read that. There we go. Okay. What is the SC Mortgage Tax Credit Program, or MCC? What it basically does, it converts 50% of your interest on your mortgage from a tax deduction to a federal tax credit of $2,000 a year, which is huge for a home buyer to be able to get this tax credit. The MCC will allow the home buyer to take a federal income tax credit off their annual interest. And so what it will do, basically will give you additional tax refund every year of up to $2,000 a year. And then the question is, who qualifies for the tax credit? Well, attached to this webinar, we have a program guide that will explain that a little more in detail. But what it basically does, we have two types of counties in the state. If you are in Aiken, Anderson, Charleston, Greenville, Greenwood, Lancaster, Lexington, Oconee, Pickens, Richland, Spartanburg, or York, the definition of first-time home buyers who've not owned the house in the last 3 years. It is a federal definition of the first-time home buyer program. Now, we do have one exception to that rule in those 12 counties, is that if you are a veteran that's been discharged in the last 25 years, anything other than dishonorable, we'll waive that first-time home buyer for all those veterans out there. So a lot of people in those counties qualify for the first-time home buyer program that we offer. Now, in the other 34 counties in the state, the definition of first-time home buyer is that you do not own the house at the time of closing. So you can easily buy your next home and use this tax credit. So what you would have to do is have your current house, say you are in Charleston County, and you sell your house in Charleston County and move to Berkeley County. You're a first-time home buyer with us when you close in Berkeley County. So you could close at 10 o'clock in the morning on your Charleston house, and then close at 10:01 on your house in Berkeley County, and you're a first-time home buyer. Same thing goes in, like if you're in Richland County, you want to move to Kershaw County or Sumter County, you'd be the first-time home buyer in that aspect also. Now, you cannot go from Kershaw to Richland and be a first-time home buyer. You always have to check in the county that you are going to buy the house in to see if you qualify for the first-time home buyer program. Now, what it can do a couple of things. It can increase your take-home pay. You'll get your tax credit, and you will be able to go to get your W-9, and then you take that in W-4. Yeah, W-4, excuse me. The W-4, and with your employer, and you can say you get the full tax credit. You can go in and change your deductions to get that credit monthly to help make your house payments and make your house a little more affordable.
So there'll actually be more money in your check at that time.
Every week, when you get paid or whenever you get paid, you'll have additional funds in your check to help make your house payment and to make your house affordable.
And again, this is all sanctioned by the IRS. And HR should know about this.
Yes, they should.
For your employment.
Yeah, the tax credit is through the IRS, so it's a very well-known program in most states. But this is only the second one we've ever offered in South Carolina. The first one was expired in June of this year, and this next one we will have, and it's actually for $75 million. So we hope that should be available through December of 17. And then we'll have to get a new one at that point.
And let's just mention up front that everything you're hearing today, this is all launching on Monday.
The 16th. It will be on our website starting early on Monday morning.
That's when we're closing. So if you've got somebody that's interested today, you can go ahead and sign them up. But Monday's the official day.
It's the official day, and it normally there's a few forms that the borrower will have to fill out. There's about 7 forms that's in a package that the lenders will be able to do for you at their office. We do not do anything in-house. This is all done through approved lenders in our programs. And now, like I said, if your lender does not work with us currently and want to offer the tax credit program, they can go online at schousing.com/tax credit and get an application. Or they can also go to just schousing.com lending partners and scroll down on that page. You'll see the application they can get. Very simple application, and it only takes about 48 hours to get approved after we receive the package. So it's really easy for your lender to get approved.
And that's important because this all takes place at closing, correct?
Yeah.
And are most of the big lenders working with us now?
We have 63 lenders that work with us, and we have about 35 brokers that offer this program statewide. But most of your big ones, Wells Fargo, Midland Mortgage, Gill Mortgage.
But there's only 1 or 2 that do not. Let's put it that way.
Yeah, only a couple of the big ones do not on there. But there's a list on our website of who qualifies or who will offer this program. And if you have any problems, you can always contact me, and that's not a problem at all to contact me on finding somebody that you can work with for this program. Now, the cost of the program for your borrower, for the person, will be $500 fee to us for the certificate, and the lender can charge up to $200 in processing fee, and that's up to the lender what they charge for that fee or not. But most lenders do charge, I will say that. So it's a total of $700, which is a very nice thing to think you pay a one-time $700 fee and get up to $2,000 for the life of your loan. That is huge to help you out.
And it's also the lender or the seller can pay it for the borrower.
Yes, the lender, borrower can pay it, seller pay fees, and then you've got your lender can pay it with the lender paid fees also.
Under any circumstances, though, it's practically free money. I mean, even if you pay $700 for it, you're going to get money back every year.
As long as you have a tax liability.
Yeah.
You have to have a tax liability to get it.
We'll get into more on that.
And a little more on qualifying. Of course, you have to be a person in a house in South Carolina. You can't use this in another state, but a lot of states have this. I know that North Carolina has one, Georgia does not, but Florida has one, and then, like I said, states all over the country have this tax credit they offer. And it's always different, too. Like ours is a 50% tax credit on this relaunch. Some are 30%, some are 20% in different states. So I'll have to check if you go out of state and do one, make sure you check. But our new one is 50%, which is huge.
And that's important because those of you who remember this from the last time we did it, it's better now.
Yeah.
We should say that this is a really enhanced program. The last one was 30%, which was great. People loved it. This time it's 50% for the same cost.
Yeah. Exactly. Also, you must occupy your home as your primary residence. So if you decide to rent that house out after you get the tax credit, you would lose that tax credit if it's not your primary residence. If your household income falls within the income limits of a county, you have to check with income limits for each county. There are specific limits for each county throughout the state. Just as an example, in Richland County, one person, a single person, or a couple, or a single mom and a child can make up to $64,700 in Richland and Lexington County in this area where we're talking from. 3 or more can make up to $74,000, and the maximum sales price is $275,000 in this area. Now, if you go on the coast in Beaufort and Berkeley County, it's $295,000. So always check the county that you're going to be in to see what those limits are. And also on the people like in Beaufort is $82,000, over $82,000 for one person or two, and then at $96,000 for 3 or more. So always check that county to see what the limits are before you tell your client they qualify or not.
And all of this is in the program guide that we're going to make available to you right after the webinar.
Yes, no problem with that at all. That'll all be spelled out, and it's the last page of the program guide is the income and house price limit charts that you'll be using. And so one nice thing that you think about now, every house that you have listed that are $275,000 or less in most counties qualify for the tax credits. You can actually advertise your house as qualifying for the tax credit. Maybe your borrower does not, but the house qualifies. And if you work with builders, builders love this, to be able to put that in, that their house qualifies for this tax credit. The odd thing about this tax credit, it cannot be used with the South Carolina State Housing Loan with down payment assistance.
It's our program, but you can't use it with one of our loans. You can't double dip.
That's exactly right, because both of these are used our bond cap to use, and so you can't double dip into that. So you cannot use it with a state housing loan. You cannot use it with a direct USDA loan or a 203K financed FHA loan. You cannot use those three, but all other types of loans qualify. Fannie Mae, Freddie Mac conventional loans, a fixed rate, adjustable rates, FHA, VA, USDA, any of those loans can do it. You just cannot use it with our down payment assistance programs. Now, you can use it with any other type of down payment assistance program. So if your lender is a Federal Home Loan Bank member and they have the down payment for Federal Home Bank, you can use that. Local housing authorities, such as in this area, Richland County, City of Columbia, Lexington County, if they have any funds available for down payment assistance, you can use their down payment assistance programs and get the tax credit. So, which is really, really a great deal for someone to get a house. It can also be used with new construction and any existing home. So there's no qualification restrictions on that. And some manufactured homes, condominiums, and townhomes may also qualify for the program. Now, how it works with for your borrower. Here again, they must be in the income and house price limits always. And what they'll need to do is bring with a lender is a executed sales contract with a legal description of the property, so you can make sure that it is in South Carolina. We will also need federal transcripts. The lender will order these for you, but in the last 3 years, so we have to document your income to make sure that you qualify for this program, and that you have not owned a house in the last 3 years in those 12 counties. So we do get 3 years of transcripts. We'll also need all your verification of income, at least for the last 60 days of pay stubs, and then year-to-date figures. And now, this program is also total household income. So anyone that's 18 years or older that lives in the home, we have to count their income. So if you have a 19-year-old that's working full-time, we would have to count their income if they're living in the household. So just make sure that you do understand that up front. If they have any other people, grandma lives with them. Mm-hmm. Yeah, that's even a person you have to count their Social Security income possibly. But we do verify income, and we check it very closely on that. The lending partner will do all the paperwork for this program. They will do all the paperwork, send it in to us for review. They'll also decide whether you qualify for the program or not, and for any of the program. We will issue a commitment letter to the lender before the loan closes, because the only way you can get the tax credit is to show on your HUD-1 at closing. That's probably one of the biggest questions that we get and complaints that we get from people. They call us up a week after closing and say, Claude, I need to get a tax credit. I just found out about it. Well, if you don't do it on closing, you cannot get a tax credit. We can't go back in time, unfortunately. We don't have a time machine to do that, but we do need to. It has to be on the HUD-1, and the fees have to be shown on your HUD-1 to be able to take that credit. So make sure that you do apply for that before you close your loan. We will send it. Normally takes us only a 48-hour turnaround for approvals, so it's very quick in our office to be able to get that approval for the tax credit. And a loan must close within 60 days of that commitment letter being issued. But I will let you know up front is that say you're working on the loan for 60 days, you get your commitment, here's another 60 days. Well, if it goes over 120 days, we do have to revalidate the income prior to closing, because something could change between that time and you may not qualify because your income might have gone up in that time period.
It's not a disqualifier, it just has to be re-verified.
Yeah, it just has to be re-verified to make sure that your income hasn't jumped or something, which could happen on there.
Now, that last point, go back for just a second, because this last point is what we're going to come to next. And in just a few minutes, we're going to work through some examples. But the monthly tax credit can be used to help the home buyer qualify for their mortgage. This is important, and we're going to have some examples in just a couple of minutes.
Yeah, we'll talk about that, how you can use the tax credit to qualify
this
for
is
that
what's
mortgage.
important for realtors, I think, is that your buyer may have more money than you think they do.
Yep, and like I said, they can actually buy more house, or they can reduce their payments if their ratios are a little high or something to help them qualify. So there's a lot of ways to use this tax credit. Now, you can save on using the tax credit in two different ways. You can reduce your federal withholding. We talked about this a few seconds ago, where you can get your W-4. You can change that to be able to get more money in your paycheck each week. And so that is a great way to get that tax credit in your hand faster. The other way is to actually get the tax credit in a lump sum at the end of the year, and just when you file your taxes. Now, here again, this tax credit is for 50% of your annual mortgage loan interest per year. So up to $2,000 a year is the maximum you can get. So a lot of cases now with the homes being at higher prices that we're seeing, even with the house authority loans, we've seen higher prices this year. You can get that total $2,000 for a number of years and easily get $25,000 or so in tax credits over a 10-year period, which is a lot of money back in your pocket.
Yep. And again, it's in those first few years when your mortgage taxes, that's what you're paying so much of, instead of just throwing it out the window, as a lot of people think. That they look at that statement, that amortization, and they say, well, I'm only paying interest. I'm only paying interest.
And think if you use that tax credit, say you get it every year, and you could use it, but you don't really need it that badly. You could pay $2,000 a year off your balance at the end of the year when you get your tax refund.
Right.
And look how fast that balance will go down if you're paying $2,000 extra a year on that.
And again, dollar for dollar, a tax credit. So what so many people don't understand, and we'll also post a really good article that was in the Post and Courier from the last time we did this, where David Slade actually goes over the specifics of this. And we've also been on South Carolina Business Review and a couple of other places where this is the important point. Tax credit, that's dollar for dollar. But 50% may still be a deduction. Right. Deduction isn't as valuable, but it's still going to reduce your tax.
Well, I said this doesn't throw out your deduction. So, and we'll talk about it a second ago with the example. But say your interest is $5,000, and so you take $2,000, you have $3,000 left. You still get that deduction off your taxes also. So you get the credit and the deduction. So, which is a really a nice item that's available.
Let's go some examples. Let's look at how this really works.
Yeah. Now, let's take these are actual numbers that we used averages for our loans last year. So this is actual numbers on what people actually save with our program. say your house price is $143,000 and you're financing $137,000. This person has an income of $44,000 and the interest rate on that loan was 4%. Their interest that they would actually have to use would be about $5,400 is what the interest on that money would be. So here again, this person would be able to reduce their taxes by $2,000 and still have 27, let's see, I think on the next slide, get it right. Yep, okay. They would have $3,400 remaining that they could take as a tax deduction. So that's really, you think about that. That's, you got your deduction, you got your credit. But now, I will say, you have to have a tax liability to have a tax credit. If you pay no taxes, well, you can't get something from zero.
Right.
So you have to have a tax liability to be able to take this credit. So,
and they will have to itemize.
Yeah, they will.
Things,
we'll have to itemize to get this on here.
But that's another $166 per month that you can put toward a tax payment.
If they get it on a monthly, you think of it monthly, that's $166 a month that you're saving on your taxes.
Yeah, and so that's just our average borrower. So.
Right. Now, someone that's getting a lump sum credit, same scenario, $143,000, $137,000 loan, $5,400 interest on the loan, that they would take the full $2,000 that they would get. Here again, still have the $3,400 in the taxes. So this would increase their their refund by $2,000. And just as another example is, say I filed my taxes, I owed $4,000 in taxes, but they took $6,000 out of my check. Well, I normally get a $2,000 refund. I'd be pretty happy with that. With this program, I would now get a $4,000 refund, which is makes somebody even happier to get every year on here.
So this is real money.
Real money, dollar for dollar federal tax credit. And here again, we talked this. You cannot get a negative liability with this tax credit. So you need to make sure that you do have that your client does have a tax liability to be able to take this tax credit on there. Now, we also allow, say you have a brand new graduate. Well, they really never pay taxes. They just got their first job. But everyone knows that even though they didn't have zero last year, they're going to be paying taxes next year from now on with how they got their full-time job. They can still buy the tax credit now in anticipation of them having a tax liability in the near future. We will allow for that. That's a change. We used to not allow for that. We now do with this program. We allow now.
And again, that's what this is what the disclaimer at the front says. So read that. But we're not giving tax advice. We want to make sure that everyone that gets this, please tell them to consult their tax advisor. Make sure that they do qualify. Most people that fit into this category that are able to take advantage of it will, but we just want to make sure that everyone knows we're not giving tax advice on this. They do need to consult. Now, having said that, might also add one other thing is that they may also be able to carry forward in some circumstances any that they didn't claim in the first year. There's some tax individuals where there may be a 3-year carry forward. We can't say that's for everybody, but there are a lot of states that are doing this where that's allowed. So again, their tax consultant could tell them.
Make sure you check with them because we are not tax experts by any stretch of the imagination. And here again for complete requirements, charge counties, everything, you can find it on our website starting Monday at schousing.com/tax credit. And also attached to this, you will also see have the program guide that's got all the detailed information that we have on the program.
And also we're going to have available all the collateral material for this. We're going to have the signs. Some of you may have seen the blue and white signs that attach to your sign as a realtor, or you can put them in the window of the house saying this house qualifies for an SC tax credit. We'll have the brochures. We'll have fillable brochures that you can put your information in. That'll be available online. You can download those. Again, the all-important program guide, you can go and look at that right away. That's going to be available here. and we're also going to have that on our website. And if you're really interested in increasing your business and just being a smarter person and being able to entertain your friends, you can come to one of Claude's trainings out in the field. I don't remember them, Claude. Where are you going to be coming up in the near future?
We have got training classes scheduled in Rock Hill, actually on this coming Tuesday, and Columbia on next Thursday. I don't have all the dates in my head today, but if you go to our website at schousing.com, click on Lending Partners. We call our realtors, our lenders, all lending partners with us, and you'll see training. You can go down and you can sign up for one of those training classes. We have Rock Hill, Columbia, Greenville, Charleston, Myrtle Beach, and hopefully Beaufort area also. Before the year end, we should have all those done. So,
and the Realtors Association has offered to post those here in their educational materials too. So if you're coming to your association's website, which you should be frequently to find out what's available, those will be here as well.
Right.
And also, if you've got a group, I mean, I'm not trying to make more work for Claude, but I know that if you've got an office that has a number of people in it who are interested in it, sometimes Claude can fit it into his schedule to come to you.
Yeah, if I can ever fit in my schedule, I do need a couple weeks notice. I'm more than happy to come to your office if you have at least 15 or more. We can come to your office and do an in-house training. And one nice thing about it, if you go to one of our training classes or I do an in-house training for you, it takes about an hour 15 minutes depending on questions. We actually put you on our website. If you check on our website under first-time home buyers, you'll see on the right-hand side of the screen it says find a realtor. And each county, we list all the realtors go through our classes. And if you go to the class, we list you for 3 years on that before you have to come back to another class and get recertified. But it's a great way to get your name in one more place. And it's amazing how many people click that site. I can't even hundreds of thousands, millions of hits we get on that site a year. People looking for information about our programs and also our lending partners, our realtors that's going through our classes.
And it's listed by county, so if somebody's looking in Fairfield County, they're going to come to that page and see.
And we only list what you do most of your business in, so we don't. You can't go in and say I want every county in the state, because I know if you're in Oconee, you're not going to Overy County and do a showing. So whatever counties that you do your business in, we will list you there.
Also, just want to mention that above and beyond all the collateral material that we're going to provide for you, we have also made a very large purchase of newspaper ads. So the ad for this and for our regular program, for our home buyers program, which is still offering up to $7,000 in down payment assistance. You can't use this with our program, but one or the other, you should be able to sell a house with it. But we'll be buying quarter-page ads in every newspaper in the state, dailies and weeklies. We're going to do that for about 4 weeks to launch the program, and then we'll come back in the spring with another big push on it. But this is one more way that we're trying to help you move some houses.
And always keep in mind, Palmetto Heroes will be coming out in April. We're already starting to work on it, so can't give any details or anything like that. But April 20th, we're going to roll that new Palmetto Heroes out for 2016. So that's also coming. Do we have any questions today?
Yeah, we got a couple questions. The first one is asking about where you guys said that homebuyer since can't be listed housing. But they were asking about one system called community works homebuyer assistance.
Yes, they could. Mm-hmm. Yeah, any type of down payment assistance that's HUD approved, which Community Works, I know who they are, is a HUD approved down payment assistance provider. They can use that down payment assistance to get that and the tax credit.
Okay, we got another one who asked, can you please explain how this works when purchasing a home in target counties again?
In targeted? Okay. In target counties, here again, the definition of first-time home buyer is you do not own a house at the time of closing. So I'm just going to use Columbia at Richland County as an example. In Richland County, you cannot own a house last 3 years. So Kershaw County is a targeted county. So if you're going to move into that targeted county, Kershaw, then you're a first-time home buyer. As soon as you close on your house in Richland, say 10 o'clock, at 10:01, you're a first-time home buyer with us. So with that, you could now qualify for the tax credit program or any other of our programs that we offer.
In those targeted counties, the first-time home buyer rules are essentially waived.
Yes.
Yeah. Mm-hmm. Are there any categories for this where we waive the first-time home buyer rules?
The only thing is for veterans.
For veterans, that's right.
The veterans that have been discharged the last 25 years, anything other than dishonorable, will waive the first-time home buyer rule for the tax credit program.
Right. Any others? Send those questions in. We love answering questions.
In non-targeted counties, would a refinance qualify for a credit?
Oh, great question.
Yeah.
I'm glad you brought that up.
Unfortunately, it's got to be a purchase. The only thing we can use this for is a purchase loan. Now, but we will allow, say you get a tax credit with your when you purchase your home, and you go to refinance for $250 fee. You have up to 12 months to decide. We will actually convert that tax credit to your refinance loan. But it has to be, the tax rate has to be on the original loan that you got when you purchased the house. You can't get it on a refinance right now. If so, I think everybody in the country would be doing this. I wish we could, but it just can't do that. It's got to be originally on the loan.
But if you do refinance that house, the house that you purchased the tax credit for, you can take it with you.
Yes, you can.
And that's another great selling point. You don't lose it. Say you refinance, something happens in 3 years, you get an opportunity to refinance, you don't have to lose that $2,000 a year.
Yep. Okay.
What are the numbers for Charleston County for income and sales price?
For Charleston County, in Charleston, one person or two can make $62,900. 3 or more can make $72,335, and the maximum sales price is $295 for Charleston County.
And so that's the maximum household.
And it's odd because in Berkeley and Dorchester, the income is $75,480, $88,060 for 3 or more, and $295 sales price in that area.
And we don't make these up, folks. This is what HUD gives us to work with. So we can't always figure out exactly why, but that's the numbers they came up with.
Yep.
And again, all of these by county and by occupancy, household makeup are in that program guide. We tried to put everything in there along with some examples for you. So do take a look at that.
All right, if anyone else has any other questions, please type them in now. We've got a couple different questions asking about the different numbers for counties. Again, guys, all that information is in the program guide. If you go under the handout panels, you should see the PDF there, and you can download it, and that has all the information in it. Also, we'll be posting a copy of this presentation recording along with the program guide. You can download that. You go to screaltors.org/webinar-archive. One more time, that's screaltors.org/webinar/archive. And got one more question that rolled in. Are the new lending documents and disclosures going to affect this program at all? HUDs are not used on loan requiring vendors.
Yeah, and I say HUD 1 just as I just used to say no, right. but no, the TRID documents did not change how you do the tax credit program, so that should not be anything because the fee is a third-party fee, so it doesn't really affect a lot of the any of the disclosures or anything like that with the TRID documents.
And there is a line for tax credits on tax forms. I didn't realize this until we started doing this, but there is actually a line on the federal tax forms. And again, this is a federal tax credit.
Yes,
it's not a state tax credit.
Tax credit. Federal and I've even checked Tax Act, H&R Blocks, and TurboTax.
Right.
And it actually asks you, as you're going through it, says, do you have an MCC? You click that MCC box, and boom, there's everything is done for you. So it's really easy to get this tax credit every year. And here again, just a reminder, you have to have a tax liability to take a tax credit. It's not like the earned income or the like your single mom has 4 kids that has no taxes but still gets $5,000 back. It's not something like that. You've got to actually pay taxes to get it. Okay, well, great. Well, I want to thank y'all so much for tuning into this today. And if you have any questions, you're more than happy to, as they say, call me, because I'm on the road so much, I'm not in the office anymore, but you're more than happy to email me questions at claude.spurlock@schousing.com. That's CLAUDE.spurlock, SPURLOCK @schousing.com. I'll be more than happy to answer your questions. And here again, if you want me to come to your office and have a big office and do a class, just let me know. I'm more than happy to come do that. We be late, probably December or either first of the year to be able to come out, but be happy to do that.
But we do have scheduled trainings all around the state, so look on the website here under educational opportunities for some of those, or come to our website and see what we've got. We've got, you know, it's always good. We've got down payment assistance on our regular program. We've got the MCC for people who are using a loan that is not a state housing loan. We've got a lot of good tools for you and a lot of good material that you can use, so please take advantage of it.
Right, thank you.
Thanks.
Thank you so much, and like I said, hope to hear from you all soon.